In America, there's a story we tell ourselves. It's a story about markets, where success is earned through innovation and risk, and fortunes are made by brilliance and lost by failure. It's a comforting thought that no single institution, no matter how powerful, can truly shape the direction of the global economy. But what if that story is incomplete? What if one firm, quiet, disciplined, and almost invisible to the public has spent more than a century positioning itself at the very center of power? A firm that doesn't just survive financial crises, but thrives on them. That doesn't just advise governments, but staffs them. That doesn't just trade markets, but helps design them. This isn't a story about a company that simply makes money. This is a story about a company that understands money. Goldman Sachs. They've been called the smartest firm on Wall Street, the most secretive bank in the world, the vampire squid wrapped around the face of global finance. Its alumni have held the highest offices of government. Its fingerprints appear at the scene of almost every major financial event of the last 50 years. And yet, despite all this, Goldman Sachs rarely explains itself. This creates a deeply unsettling paradox. How does a firm so frequently linked to crises continue to emerge stronger after each one? Tonight, we aren't here to accuse or defend. We're here to understand, to trace the origins of an institution that mastered not just markets but the rules behind them. And the most important question woe ENT answered until the very end. Is Goldman Sachs merely a reflection of the system, or is it proof that the system itself is designed to reward those who see the future before everyone else? To understand Goldman Sachs, we first have to understand the world that created it. The US financial system didn't just appear fully formed. It was forged in crisis, war, and economic booms. In the late 19th century, America was transforming. Railroads, steel, and oil demanded capital on a scale never seen before. Banks were no longer just vaults. They became the engines connecting savings to ambition. This era gave birth to investment banking. Unlike the bank on your corner, these firms raised money by underwriting stocks and bonds, helping companies grow, merge, and survive. But there was a problem. Markets were chaotic, regulations were weak, and trust was fragile. Financial panics were common. In this environment, survival depended on one thing: reputation. Trust was the real currency. This is where Goldman Sachs begins. Founded in 1869, it wasn't a financial empire. It was a small partnership, built on personal relationships, discretion, and an obsessive focus on managing risk. From the very beginning, Goldman understood something its competitors didn't. Money flows towards stability, and stability is created not by size, but by credibility. This principle, quiet credibility over public dominance, would define the firm for generations, but culture alone doesn't explain power. To see how Goldman grew from a small partnership into a global force, we have to follow the story step by step. It all started with Marcus Goldman, a German immigrant trading commercial paper short-term IOUs from merchants. When his son-in-law, Samuel Sachs, joined, the firm became Goldman Sachs & Co. Their structure was key. As a private partnership, the partners' own wealth was on the line. Every risk was personal. This created an intense internal discipline. Hayes specialized in connecting capital with credibility, building relationships with solid companies and wealthy families, avoiding publicity, and learning to say no. By the early 20th century, Goldman had survived multiple financial panics, not by making bold bets, but by managing its exposure with extreme care. This restraint would later become its greatest strategic advantage. The mid-20th century was a turning point. After the Great Depression, finance was tightly regulated. The Glass-Steagall Act built a wall between commercial and investment banking. For decades, this kept Wall Street in check. But by the 1970s, inflation and global competition started straining the system. The old rules no longer fit. This is when Goldman adapted faster than anyone. The firm invested heavily in talent economists, mathematicians, and eventually computer scientists. It embraced quantitative analysis long before it was trendy. Goldman didn't just trade markets, it modeled them. It expanded globally, embedding itself wherever capital was needed. And crucially, it remained a private partnership long after its rivals went public, allowing it to focus on the long term. free from the pressure of quarterly earnings. But the world was changing. Deregulation accelerated in the 80s and 90s. Financial innovation exploded. Derivatives, securitization, and complex new instruments were transforming markets. She'd mastered Italiano. Then, in 1999, Goldman Sachs went public. This wasn't just a financial event, it was a philosophical one. Going public meant access to enormous capital, but it also meant new incentives, relentless growth, and shareholder returns. Some feared it would dilute the firm's culture. Others believed it would amplify its influence. Both were right. As a public company, Goldman expanded aggressively into trading and structured finance, becoming a central player in mortgage-backed securities and other complex derivatives. At the same time, its alumni increasingly moved into government. Treasury secretaries, central bankers, and top regulators often had Goldman on their resumes. This phenomenon got a nickname: the revolving door. Supporters said it was natural. Government needs expertise, and Goldman attracts top talent. Critics saw something else: regulatory capture. The lines between Wall Street and Washington were blurring. Then came 2008. The global financial system froze. Housing markets collapsed. Trillions of dollars in wealth vanished, and Goldman Sachs stood at the center of the storm. The firm had been deeply involved in mortgage securitization. It traded the very derivatives tied to housing that were now imploding. Yet Goldman survived. More than that, it emerged profitable. How? The answer is preparation and positioning. Goldman had started reducing its exposure to subprime mortgages earlier than its rivals. It hedged aggressively. It held onto its cash. When the market collapsed, Goldman still had access to capital. But that's not the whole story. In September 2008, Goldman converted into a bank holding company, giving it access to the Federal Reserve's emergency liquidity. The government, and by extension the taxpayer, became the ultimate backstop. Goldman repaid the bailout funds with interest, but the damage was done. Millions lost their homes and jobs. Trust in the system evaporated. A powerful narrative took hold. Wall Street was protected while Main Street paid the price. Goldman became a symbol not necessarily of wrongdoing, but of a system where losses were socialized and gains remained private. In the aftermath, Goldman faced investigations and paid billions in fines. Its reputation was battered, but structurally, very little changed. Markets recovered. Profits returned. The fundamental question was never fully addressed. Why did the system allow institutions to become so interconnected that their failure threatened the entire economy? Post-crisis reforms like Dodd-Frank aimed to reduce risk by requiring banks to hold more capital and restricting certain trading activities. But the system is adaptive. Risk simply migrated to less regulated corners of finance, like hedge funds and private markets, and Goldman adapted faster than the regulations. It reduced some risks, expanded into asset management, and even entered consumer banking. The pattern was clear. Regulation reshaped behavior, but it didn't eliminate the concentration of power. Today, the economy faces familiar pressures: high debt, asset bubbles, and aggressive central bank intervention. And once again, Goldman is positioned at the center, advising governments, trading global markets, and shaping financial narratives. Think about this cycle. Crises increase volatility. Volatility increases the demand for expertise, and expertise concentrates power. Goldman thrives in complexity. In recent years, wealth has shifted from public stocks to private markets, private equity, private credit. These markets are less transparent, less regulated, and more profitable. Goldman has followed the flow. At the same time, central banks have become the most powerful players in finance. Goldman's proximity to policy discussions gives it invaluable insights. This creates a modern paradox. The more unstable the system becomes, the more valuable intermediaries like Goldman are. Instability isn't always a threat. Sometimes it's an opportunity. This story isn't about heroes or villains. It's about incentives, structures, and foresight. Here are 3 critical takeaways. First, real power in finance is rarely visible. It's about shaping frameworks and expectations. Second, crises reward preparation, not morality. Survival is determined by liquidity and positioning. Third, The system doesn't eliminate risk, it just redistributes it. Losses often travel downward, while stability flows upward. Goldman Sachs didn't create this system, but it learned to read the rules of the game better than almost anyone else, which leaves us with an uncomfortable, open question. If institutions like Goldman are simply playing by the rules, what does that say about the rules themselves? And if history keeps repeating, are we learning from it, or just getting better at predicting the next collapse? If this video made you think differently about money, power, and history, please like, subscribe for more deep dives, and share your thoughts below. The most important conversations about finance are the ones we rarely have in public.